Be Wealthy and Smart, episode 1348.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about, will a slowdown in the labor market bring lower interest rates? Now, as we all know, the Fed has been looking at the markets very carefully. And on the one hand, they want full employment, but on the other hand, they want inflation in the 2% range. So far, unemployment is going up, which means we're seeing the weakness that the Fed wanted to see, but we still have higher inflation than what the Fed wants to see, around the 3% area instead of in the 2% range. Now, we've seen rents and insurance keep inflation trending higher, but recently, we're seeing a trend of lower rents start to happen. And if rents start to decrease, that could get us in the sweet spot that the Fed is looking for in that 2% inflation range. And we are seeing unemployment benefits at the highest level in more than 8 months. And the economy added the fewest jobs in 6 months in April, while job openings dropped to a 3-year low in March. Christopher Rupke, chief economist at FWD Bonds, said the labor market shows some signs of rebalancing, with fewer job openings posted around the country, and now company layoffs are picking up, hinting at caution on the part of companies as they weigh the outlook for the second half of the year. When you look for claims for state unemployment benefits, they increased 22,000 to a seasonally adjusted 231,000 for the week ended May 4th, which is the highest level since last August, and was the largest increase in nearly 4 months. So more people applying for benefits means more people are out of work right now. Now, some of that people are saying is seasonal and could be related to things like schools taking spring break. Other people think it's a more important trend. For example, Citigroup employees were laid off in January, but were paid through April, and so they were making their first claims of unemployment after being laid off for 4 months. There's also more unemployment applications happening in sizable increases in California, Illinois, Indiana, and Texas. Only Iowa reported a drop in unemployment claims in excess of 1,000. And sentiment surveys, including the Institute for Supply Management and the NFIB, have been flagging a sharp slowdown in the labor market. All of this weakness in the labor market momentum means 2 interest rate cuts from the Federal Reserve are back on the table. And it looks like people think the first cut could happen in August. But should inflation come down, again, if rents have a lot of weakness and stop escalating, that will definitely be a move in the right direction that we've been looking for. Should that happen, that could put more rate cuts on the table. So it all is going to come down to what are rents doing. What's driving rent price growth? Nicole Bashad, senior economist at Zillow, says it's from a combination of low inventory of homes for purchase, high costs of home ownership, and few rentals available, all putting pressure on the rental market. And it's not just high prices keeping people in their rental homes. Mortgage rates are also elevated, which increases the cost of buying a home. She said, when we look at why we have so many renters and so much demand for rentals right now, it's not for lack of people wanting to buy homes, it's for the lack of ability to be able to buy homes. There are no homes available to buy, and the ones that are available are oftentimes unaffordable for the majority of potential buyers. Nationwide, rents grew 30.4% from 2019 to 2023, about 1.5 times faster than wages, which grew 20.2%. When it comes to rent unaffordability, New York City leads the pack by a long shot. At the start of the pandemic, New York City, as droves of renters left the city, rent prices dropped. But as soon as services and offices began to reopen in New York City, demand to rent and buy homes in the city skyrocketed. an upward trend that hasn't slowed in recent years. From 2022 to 2023, New York City wages grew 1.2% and rents spiked 8.6%, 7 times as fast. Bashod said, "We have about 7 times faster growth in rent in New York City, which is extremely problematic for New York renters who are trying to keep pace with these growing prices because they just do not have the income growth to sustain that." So that's the trend that has to be countered. And once rent inflation levels off or starts to decline a bit, that could put us in the right inflation expectations, and the Fed can look to be easing interest rates at that time. We've got one side of the barbell is in a good position. The other side is just slightly elevated. Once that drops, I think we'll start to see interest rates decline more than what people are expecting right now. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.